A $50 gift card disappears into a kitchen drawer. The store has the cash, but it still owes someone $50 of stuff. If the card stays there for years, who eventually keeps the money? The obvious answer is the store. The accurate answer takes a few more steps. That little card creates two different stories at the same moment. One happens in a bank account. The other happens in an accounting ledger. Later, federal rules and state laws may add a third story. Follow the same $50 through all three, and the business of unused gift cards becomes much easier to see. A gift card feels like money because it has a dollar amount printed on it, but it is not as flexible as cash. $50 in cash can go almost anywhere. A $50 store card usually works only inside one company's system. That restriction is the point. The person giving the gift does not have to choose the exact product. The person receiving it still gets some choice. The retailer gets a future customer who must return to that retailer or let the balance sit. None of that means the unused balance becomes instant profit. First, the company has to account for a promise it has not fulfilled. Imagine the card is sold for $50 at a grocery checkout. The buyer pays $50. Cash has arrived. But the cardholder has not received $50 of coffee, groceries, or clothing yet. Public companies describe this in their filings. Sprouts Farmers Market says proceeds from gift card sales are recorded as a liability at the time of sale. Starbucks says amounts loaded onto stored value cards are initially recorded as deferred revenue. In plain English, the company has the cash, but it also owes the cardholder something. The ledger does not show a normal product sale yet. It shows an obligation. Put the two entries side by side. On the cash track, plus $50. On the obligation track, $50 still owed to whoever uses the card. That separation matters. Cash flow answers, where is the money? Revenue recognition answers, has the company delivered what it promised? Those questions can have different answers on the same day. 3 weeks later, the cardholder finds the card and spends $32. Now the company provides goods or services. Under the issuer's accounting policy, that redeemed portion can move out of the gift card liability and into revenue. The remaining $18 stays attached to the promise. The physical card may go back into a wallet with a small balance that is easy to forget. That leftover balance is not unusual as a concept, but the accounting does not depend on one employee staring at one abandoned card. Large programs contain many cards issued at different times. Some are used immediately. Some are partially used. Some are never used. Companies study those redemption patterns in groups. Suppose a retailer has years of history showing that a small, relatively stable share of card value is unlikely to be redeemed. The company may estimate that unredeemed share. Accountants call it breakage. Breakage is not a magic expiration alarm. The company does not simply wait 5 years, flip every old card to zero, and celebrate. Under the policies described by Starbucks and Sprouts, estimated breakage is recognized over time in proportion to actual redemptions. Think of a pool of similar cards. As customers redeem most of the value in that pool, the issuer updates the liability and recognizes an estimated share that historical behavior suggests will never be claimed. The estimate can change when customer behavior changes. This is why unused cards are pure profit is too crude. Revenue is not the same as profit. The company may have operating costs, program costs, fraud losses, legal obligations, and unclaimed property duties. Breakage also depends on an estimate that auditors and management have to support. The important idea is narrower. A company may eventually recognize some expected unredeemed value as revenue, but only under its accounting policy and only after considering any legal duty to send that value somewhere else. Starbucks provides a large public example. In its fiscal 2025 annual report, the company said most stored value cards were redeemed within 1 year. It also said cards in the United States and many other company-operated markets had no expiration date and no service fees that reduced customer balances. For that fiscal year, Starbucks reported two breakage revenue figures: $200.4 million in company-operated store revenue and $22 million in licensed store revenue. Those numbers are revenue categories, not a claim that every forgotten dollar became net profit. They are also specific to Starbucks and its fiscal year. The size of the obligation is visible too, but it needs a careful label. At December 28, 2025, Starbucks reported just over $2 billion in a combined stored value card and loyalty program balance. That category includes more than unused United States gift cards. It combines cards and loyalty value across the company's reporting scope. Sprouts offers a smaller, independent example of the same mechanism. Its fiscal 2025 filing says gift card proceeds begin as a liability. Sales are recognized when customers redeem the cards, and estimated breakage is recognized over time in proportion to actual redemptions. Sprouts also says its gift cards do not expire. The two companies differ in scale and program design. The sequence is the useful part: cash first, obligation second, redemption or estimated breakage later. Now, add federal consumer rules. People often compress the rule into one sentence: gift cards last 5 years. The actual structure is more precise. For covered gift cards, Federal Regulation E generally protects the underlying funds for at least 5 years from issuance, or the last load, and it distinguishes the expiration of the plastic card from the expiration of the money behind it. A physical card can display an expiration date, while the underlying funds remain available longer. In that case, required disclosures and replacement procedures matter. Federal rules also restrict dormancy, inactivity, and service fees. Such a fee generally requires at least 1 year without activity, clear disclosure, and no more than one covered fee in a calendar month. Many cards charge no such fee at all, and state law can provide additional protection. So 5 years is not a countdown that automatically transfers every remaining balance to the retailer. It is a consumer protection floor inside a larger system. The next branch depends on unclaimed property law. In some circumstances, an issuer may have to remit an unclaimed balance to a government agency instead of keeping it. Starbucks explicitly says its redemption estimates consider remittance to government agencies under unclaimed property laws where applicable. The details vary by jurisdiction, card type, and program structure. That variation is exactly why a single national claim like "the store keeps it" or "Delaware gets it" can be wrong. For our fictional $18 balance, the honest decision tree has at least 3 possible endings. The customer redeems it. The issuer recognizes an estimated portion as breakage under its policy. Or, applicable unclaimed property rules require a remittance. The same-looking card can travel through a different legal branch depending on the facts. There is one more path that viewers repeatedly connect with gift cards: scams. A forgotten balance is value sitting inside a legitimate card program. A scam is different. Someone pressures a victim to buy a card, then demands the card number and PIN so the value can be stolen. The Federal Trade Commission's warning is simple: legitimate businesses and government agencies do not demand payment through gift card numbers. If someone asks for the number and PIN, stop. Keep the card and receipt, contact the issuer, and report the fraud. Scam losses do not explain normal breakage accounting. They are a separate problem, even though both stories begin with the same object. Return to the drawer. The buyer's $50 reached the company when the card was sold. At that moment, the issuer also recorded an obligation to provide $50 of value. $32 was redeemed, so that portion moved through the issuer's revenue process. $18 remained. That balance did not automatically become profit. It stayed in the system until customer action, supported breakage estimates, and applicable law determined what happened next. This is the hidden business of gift cards. Retailers are not only selling pieces of plastic or digital codes, they are managing a large pool of promises and predicting human behavior. Who redeems, when they redeem, how much they leave behind, and whether the law sends that remainder somewhere else. The practical lesson is less mysterious. If you receive a gift card, use it while you remember it. Check the remaining balance and keep the receipt when possible. If anyone asks you to pay a bill, tax, or emergency with gift card numbers, walk away. And the next time a $50 card disappears into a drawer, remember what is actually inside it. Not free money, an unfinished promise.